All right, let's open the case file on what is easily one of the most scrutinized areas in all of tax law, S-Corp compensation. For any business owner out there, you know this is a high-stakes game. The line between a brilliant tax strategy and a really costly mistake is just razor thin, and you can bet the IRS is always watching. So let's dive in and examine the evidence.
And this is really the central question, isn't it? When you take money out of your S-Corp, is it a legitimate return on your investment, or is it actually just your wages in disguise? Because getting this wrong can trigger a massive bill from the IRS, and it's a question that sits right at the heart of countless audits and court cases.
So what's the motive here? I mean, why would any business owner risk an audit by taking distributions instead of a salary in the first place? Well, the answer lies in a tax loophole, a big one, that pits S-Corp income directly against partnership income.
Believe it or not, this entire strategy can be traced back to a single IRS decision from way back in 1959. It's called Revenue Ruling 59221. In it, the IRS declared that an S-Corp shareholder's pass-through income is not considered earnings from self-employment. And with just those few words, a massive tax loophole was born.
And here is the financial fallout from that one ruling. Look at this. A partner pays a full 15.3% self-employment tax on their entire share of the income. But an S-Corp shareholder, they pay zero employment tax on their distributions. Now, this isn't a small difference. We're talking about a powerful multi-thousand-dollar incentive to pay yourself as little salary as you think you can get away with.
Okay, so with a motive that's strong, you know the IRS needed a way to fight back. They are not blind to this loophole, not by a long shot. And they've built a pretty specific legal framework that's designed to catch business owners who try to exploit it. Let's take a look at their playbook.
So according to the tax code itself, specifically Internal Revenue Code Section 1366, an S-Corp's income flows to its owners in a couple of different ways. But the one we really care about, the one at the center of this whole thing, is the non-separately computed income. Now, don't worry about the jargon. Just know that this is the company's main pot of profit, it's the source of all those distributions, and it is ground zero for this entire debate.
The IRS's argument here is actually pretty simple. It's like, look, if you're an officer of your corporation and you perform real work for it and you get paid for that work, then you are an employee. It doesn't matter if you call that payment a salary, a distribution, a dividend, or a loan. For tax purposes, you're an employee and you need to be paid like one. Simple as that.
And this leads us to the IRS's primary weapon. Because if they can classify you as an employee, then they suddenly gain the power to look at every single dollar you receive and decide for themselves what that money really represents.
So about 15 years after creating the loophole, the IRS issued Revenue Ruling 7444 to try and shut it down. This ruling gave them what's called the substance over form doctrine. It means the IRS can completely ignore the label you put on a payment. You can call it a distribution all day long, but if it looks and smells like payment for your labor, they will reclassify it as wages and send you the bill for all the payroll taxes.
Of course, this doctrine has been tested again and again and again in court. So let's crack open the case files and see exactly how judges have ruled when the IRS has decided to challenge these compensation strategies.
The foundational case, the one everyone points to, is Joseph Radtke versus the United States. It's a classic. So Radtke was a lawyer, the only employee, and he paid himself, wait for it, $0 in salary. Instead, he took all his compensation as dividends to avoid FICA and FUTA taxes. Well, the court was not impressed. They called it a subterfuge for reality and established a really clear, bright-line rule. If you perform substantial services, you simply cannot pay yourself a zero salary while also taking distributions.
But, what about the cases that aren't so obvious? The modern battle isn't about zero salary anymore. It's about low salary. And this brings us to the absolutely critical case of David Watson, who was a CPA. He knew the rules, but still ended up in a major fight with the IRS.
I mean, just look at these numbers. They really speak for themselves. Watson paid himself a salary of just $24,000. But his distributions? Over $200,000 in the first year and $175,000 in the second. He wasn't paying himself zero, but that imbalance was just staggering.
And here is how the court came down on it. Originally, only about 11% of Watson's total pay was characterized as salary. The court sided with the IRS and reclassified the payments, forcing that number all the way up to 43%. And the result for Watson was a huge retroactive payroll tax bill.
And here's the absolute key takeaway from the Watson case. Your intent is irrelevant. Watson actually argued that it should matter what he intended the payments to be. The court flat out disagreed. They said all that matters is the objective economic reality. What is a reasonable salary for the work that you performed, period.
So this leads us to the big practical question. If reasonableness is the standard, how does an IRS auditor actually figure out what's reasonable? Well, you better believe they have a forensic playbook that they follow to a T.
The IRS doesn't just pull a number out of thin air. They use a multi-factor test. They're going to analyze where your income is coming from. Is it really your labor, or is it your company's assets? They'll run something called an independent investor test to see if the company's return on investment is even realistic. And maybe most importantly, they look at comparables. What are other similar businesses paying for similar work?
And here it is. This is the audit trigger. The IRS algorithms are literally trained to calculate a specific forensic ratio using the numbers right from your tax return, your Form 1120-S. They compare line 7, compensation of officers, to Schedule K, line 16D, which is distributions. If that ratio of wages to distributions is heavily skewed, especially in a service-based business, well, a huge red flag goes up, and your return lands right on an auditor's desk.
So what happens if you actually lose an audit? Well, the financial fallout can be absolutely devastating, and it goes way beyond just paying the back taxes that you owe.
First off, there are some really steep penalties just for filing an inaccurate return. Right now, that penalty is $260 per shareholder per month. For a small S-Corp with just 3 shareholders, that's nearly $10,000 a year in penalties alone, and that's just the start of it.
Now, the 2 biggest hammers the IRS can wield are, first, the trust fund recovery penalty. This is a big deal because it pierces the corporate veil, making you personally liable for the unpaid payroll taxes. And second, under IRC Section 1366E, if you're trying to shift income to family members in lower tax brackets by underpaying yourself, the IRS has the specific authority to just reallocate that income right back to you as wages.
So after we've reviewed the law, the court cases, and the penalties, the conclusion is pretty clear, right? The only way to defend yourself is to not need a defense in the first place. You absolutely must have a proactive strategy. And that means doing the research, documenting how you arrived at your salary, and making sure that it aligns with the economic reality of the work you perform.
And that leaves us with one final question for every S-Corp owner out there to really think about. Look at your own numbers. Look at your documentation. Is your compensation plan a well-reasoned, defensible strategy that you could stand behind in an audit? Or, if you're being honest, would it simply become Exhibit A for the prosecution?